Now we're going to work an example here of one of the most complicated and, to me, one of the most confusing things that come about when we're looking at taxes paid by the firm and reported on the 10K, the financial statements. And this difference is what gives rise, or this confusion, it comes from an account or an entry on the income statement that's either called deferred or accelerated taxes. And this is a difference that gives rise, that comes about rather because of a difference between taxes that are paid and taxes that are reported. And that difference arises because GAAP rules and the Internal Revenue Service both require a different form of depreciation. Now, there's two different types of depreciation, and hopefully this isn't news to you. The first is called straight-line depreciation, and that's here. Straight-line depreciation is even depreciation in every year. So if I was going to depreciate an asset for 3 years straight line, then I would depreciate that asset by 33.33% in the first year. And because it's straight line, I would depreciate it evenly, so 33.33 in the second and third year. And that would be 100% depreciation here. Now, straight line is the type of depreciation that GAAP rules require, where GAAP is the generalized accepted accounting principles. These are the guidelines in the US for accounting statements. Now, the second kind of depreciation is called MACRS, the Modified Accelerated Cost Recovery System. And this is a different type of depreciation. It's an accelerated depreciation, means it allows us to depreciate our assets faster in time. And this is the kind of depreciation that the IRS, the Internal Revenue Service, will allow. And so the depreciation for MACRS is on a preset schedule. So in year one, we would depreciate the same amount, 33.33%. But in years 2, 3, and 4, we would depreciate the asset by 44.45%, and then 14.81%, and finally 7.41%. So MACRS, this is the depreciation that the IRS will allow. Now, what does that mean for us practically? Practically, it means that companies will have to use straight line when they write their financial statements and put out the 10Ks. But they may choose to use MACRS when they actually calculate their revenue and taxes to pay to the IRS. And that means that the taxes that they actually pay might be significantly different than the taxes that are listed and reported in the financial statements. And so let me show you an example of what that looks like and how it's treated. So let's say we have a $1,000 asset, and we're going to be depreciating it on a 3-year schedule using these two 3-year schedules. So we've got our $1,000 asset to be depreciated. On the MACRS schedule and on the straight line schedule. So on the straight line schedule, our depreciation in every year is the same, and we calculate that by dividing the cost basis of the asset by the number of useful years of the life of the asset. So 1,000 divided by 3 gives us 333.3, and that is going to be the same. Every year our depreciation will be exactly the same, 333.3, and this is how we're going to fill out our 10K. In the MACRS schedule, we calculate depreciation by multiplying the cost basis times the depreciation percentage in every year. And so the first year's depreciation is the same, 333.3. But in the following years, our depreciation is going to be different. We multiply the cost basis times 44.45%, and we get depreciation of 445.5. And then we multiply by 14.81% and get depreciation of 148.1. And finally of 7.41% and get depreciation of 74.1. So let's see how this looks on the income statement. I'm going to write two income statements. The first one is going to be a maker's income statement, and the second one is going to be a straight line statement. Right? So I'm just going to write revenue, cost, depreciation, EBIT, taxes at 35%, and net income. Then we'll give ourselves some time here. We'll have 1 year, 2 years, 3 years, 1 year, 2 years, 3 years. And we'll separate our income statements here. So to make it easy on ourselves, let's assume revenue of $1,000 in every year. And remember, these are just duplicated income statements, so there's nothing different here. We have costs of $250. And then our depreciation. Now, depreciation on the maker's schedule is listed right here. 333.3, 445.5, 148.1. And for straight line, it's always the same. It's always 333.3. So straight line, I depreciate the asset fully. Makers, I haven't fully depreciated the asset until the 4th year. But I have accelerated the depreciation from years 3 and 4 into year 2. Right? So I have a higher depreciation percentage in year 2, a lower depreciation amount in year 3. That's what the accelerated refers to. EBIT is revenue minus cost minus depreciation. So it's 416.7 in the first year. It's 304.5 in the second year, and 601.9 in the third year. On the maker's schedule, in the straight line schedule, it's the same. It's always 416.7, because again, in the income statement on the straight line side, all of the values are the same. Here, depreciation changes in every year, so our EBIT changes. Taxes then, reported taxes are going to be 145.84, and then 106.57, and then 210.66. And on the straight line side, they'll always be 145.84. And so notice right away here, the benefit of accelerating depreciation into the second year is that it significantly reduces my taxes in year 2, although it does raise my taxes relative to straight line in year 3. Now, what I'm hoping for is that the present value of my money is greater, and so I'd rather keep my money now and defer paying those taxes until later. And that's what makers allows us to do. It allows us to accelerate depreciation, thereby deferring taxes to a later period, and the present value of those of that money is less, of those taxes is less. So I have net income here of 270.85, and then 197.92. And then 391.23. And again, in straight line, net income is always the same. It's 270.85 all the way through. So, what's the difference? This is the actual numbers. In other words, these are the taxes that I actually paid to the IRS. These are the reported numbers. because of GAAP rules, these are the taxes I report on my 10Ks. Notice that they're the same in the first year, but different in the second years, and that causes a difference in both net income and taxes reported. So I'm gonna say on my 10K that I paid $145 in taxes, but I actually only paid $106.57. And that causes a major distortion in the cash flow figures. So let's look at what that looks like. So let's write down our taxes paid. This is what we paid to the IRS. And our taxes reported, and look at the difference. So I paid maker's taxes, so $145.84, $106.57, and $210.66. Now the taxes that we report are straight line taxes, so those are $145.84 in every year. And that creates a difference for us. So the difference in year 1 is nothing. But in year 2, I have a difference. I paid less taxes than I report. And in year 2, or year 3 rather, I have a difference in that I paid more taxes than I report by $64.85. And these are what we call deferred and accelerated taxes. So these are taxes that I defer, right? I defer $39.86 to a following year. And these are taxes that I've accelerated. I paid $210, I report that. I've accelerated these taxes from a later year and paid them sooner. And the way this looks on the income statement is we would just have a new measure on the straight line side. We'd have a new entry down here that would just be deferred or accelerated taxes. And that would correct our net income so that it would report to our actually paid net income. So here I'd have deferred taxes of $39.26. Here I'd have accelerated taxes, not negative. I'd just have accelerated taxes of $64.85. That would correct my net income so that it would be the same as what I actually paid. And that's what I have to be careful for. That's what we're looking for when we are adjusting our reported taxes to our operating taxes. We need to look at these deferred accounts and make sure that we've got them all straight. Then I've got acquired intangibles, not operating, we know that. This is amortization on acquired intangibles, so that's my deferred tax liability. I'm deferring some of that amortization. Pension and post-retirement benefits, again, this is a deferred tax liability. I am paying taxes on my on the money that I owe to my pension, and I may have a difference again between reported and accrual-based taxes here. And so I've got deferred tax assets net of liabilities here. I've got a negative. I have more deferred tax liabilities because my accelerated depreciation is so high. What I want to do is identify the operating deferred tax assets and liabilities. The deferred tax assets is this is money that we have that we can apply to reduce our paid taxes in future years. So like a carry forward, this is a credit that we have from the government. We can use it to reduce the taxes that we owe. These warranty reserves, this is money that we've booked because the government won't let us pay it, but so we're basically, the government won't let us, will require us to pay taxes, even though we're not going to report that we're doing it differently. Deferred tax liabilities, like accelerated depreciation, this is money that we owe, right? And so what we're going to do is we're going to subtract our deferred tax liabilities from our deferred tax assets so that we can calculate operating cash taxes, which is the amount of taxes that we actually paid. So to convert, what we're going to do is we're going to identify the operating deferred tax assets, that's warranty reserves, and then the operating deferred tax liability, that's accelerated depreciation. I'm going to subtract accelerated depreciation amount from the warranty reserves, and I'm going to get a measure in the current year of $3.5 billion. I'm going to look at the difference, the increase. Did I make any additional deferred tax, increase in deferred tax accounts right here? And my warranty reserves went up by 50 million, and my accelerated depreciation went up by 200 million. And so the difference here is going to be between 3.35 billion and 3.5 billion, or 150 million. Right? So I'm going to subtract that increase from operating taxes of 760 million to get operating cash taxes. Now, the other items, these non-operating deferred tax assets, it's not that we ignore it, right? There's very much literal value in tax loss carryforwards and amortization of acquired intangibles and these pension adjustments, but we're going to account for them separately at a later point, right? Remember, one of the last steps when we calculate the value of operations is then to add the value of non-operating assets and other things like that. Right? So when we're calculating NOPLAT, these deferred tax assets that are operating, they're going to flow through NOPLAT via cash taxes. That means they're going to be part of free cash flow. We don't value them separately. Any other non-operating deferred tax assets and liabilities, we need to value as part of their corresponding non-operating assets. So with if we're valuing the acquired intangibles as an asset, as a non-operating asset, then we're going to value the deferred tax asset or liability associated with that acquired intangible there. Likewise with pensions or any kind of sale leaseback agreement, we're going to try to include the value of that deferred tax asset or liability when we calculate the value of the asset altogether. Again, remember, we add the non-operating assets to the value of the operating assets at the end of the DCF process. Right? We could value it as separate from a non-operating asset if it doesn't have a corresponding balance sheet account. So like a tax loss carry forward, that's not associated with any balance sheet asset. It's not associated with acquired intangibles. It's not associated with convertible debt or any of these sale leaseback agreements. It's not associated with anything. It's simply just a credit from the government that says you had a loss and you can take a credit in a future year. But that still has value, so we're going to list that credit as if it's its own asset. It's intangible, obviously, but it's still got value. And then some we just ignore. They're accounting conventions. So non-deductible amortization, we ignore that kind of thing. We won't spend a lot of time here. There's a lot of accounting convention. There's a lot of details that would apply to certain firms and don't apply to the majority of firms. But there are some deferred tax liabilities, for instance, that we just completely ignore because they don't actually exist. It's just an accounting convention that is balancing or reconciling the income statement to the balance sheet. And so we value those at zero. We don't include them in our value of the firm. And that's all I got for chapter 18. This is kind of a short chapter. We would normally only cover this in one lecture. So there's the two examples that are embedded here. We'll jump right back in. I'll get the lectures out for chapter 11, which is really important. This is the forecasting chapter, and chapter 11 is what's going to feed into the fourth homework assignment, where we're going to be doing our own DCF on a firm that I made up. With examples that I made up, you're going to need to forecast the cash flows, then you'll do a DCF model. So I want you guys to try and take all this in. I'll get the next slides up next week. And I hope you guys are staying safe, and we'll see you next week.